Investment in real estate is shaped by the same principles that guide all forms of financial investment. Yet real estate stands apart due to its unique blend of risks, rewards, management demands, and tax implications. Throughout this chapter, you learned how investors evaluate opportunities, measure performance, manage risk, and apply financial strategies to both residential and income-producing properties. This final section ties all of those ideas together, providing a comprehensive summary that reinforces your understanding of real estate as a national-level investment vehicle. Real estate professionals must understand how investment fundamentals relate to client goals, property characteristics, and long-term financial outcomes. While licensees should avoid offering specialized tax or financial advice without the proper qualifications, a solid grasp of investment concepts allows them to communicate effectively, recognize client needs, and refer them to appropriate experts when required. The concepts reviewed here form the foundation for more advanced investment analysis and help prepare you for advising buyers, sellers, and investors across a wide range of real estate scenarios. Investment fundamentals. Investment decisions are driven by three foundational characteristics: risk, involvement, and liquidity. Investors accept that the greater the risk, the higher the expected return. They also recognize that some investments require hands-on involvement, while others require very little. Liquidity varies widely across investment types, influencing how quickly an investor can convert an asset to cash. Real estate, while valuable, is less liquid than many other investments and demands meaningful participation through management, financing, and oversight. Investors seek rewards, such as income, appreciation, leverage, and tax benefits. At the same time, they must navigate risks that stem from market changes, economic shifts, operational problems, inflation, and interest rate fluctuations. Real estate competes with other investment categories, including money investments like certificates of deposit, equity investments such as stocks, and debt investments such as bonds and mortgages. Each of these offers different levels of risk, return, liquidity, and involvement. Real estate as an investment. Real estate requires careful balancing of potential risks and rewards. Investors must evaluate how market conditions may influence rent, occupancy, and appreciation. They must also account for operating costs, capital improvements, financing expenses, and changes in tax law. Because real estate is illiquid, selling a property may take weeks or months, and investors may earn a lower price if they must sell quickly. Real estate also requires ongoing management, from maintenance and repairs to tenant relations and financial oversight. Real estate investment entities. Investors may hold properties through direct ownership, syndicates, partnerships, real estate investment trusts, REITs, or real estate mortgage investment conduits, REMICs. Direct ownership provides full control, but also full responsibility. Syndicates and partnerships allow investors to pool resources and share responsibilities. Limited partnerships shield passive investors from operational liability. REITs enable individuals to invest in large-scale commercial real estate without purchasing property directly. REMICs offer structured investment opportunities backed by mortgage pools, allowing investors to choose among different tranches with varying risk and return. Taxation of real estate investments. Taxation plays a significant role in investment performance. Taxable income is calculated by subtracting allowable deductions from gross income. Cost recovery, or depreciation, allows investors to deduct a portion of the property's improvement value over time. Gain on sale is determined by subtracting the adjusted basis from the amount realized. Mortgage interest is generally deductible, reducing taxable income. Passive activity rules restrict how losses can be applied, allowing them to offset only passive income unless specific conditions are met. Investment analysis of a residential property. Residential properties used as primary residences are not income producing and therefore rely on appreciation, leverage, and tax benefits for investment return. Mortgage interest may be deductible, but depreciation is not permitted for owner-occupied portions of a home. When the home is sold, tax liability depends on the gain calculated from the amount realized and the adjusted basis. Homeowners may qualify for a substantial gains tax exclusion of up to $250,000 for individuals and $500,000 for married couples who meet ownership and use requirements. Investment analysis of an income property. Income properties generate both ongoing cash flow and long-term gain. Pre-tax cash flow is calculated by subtracting operating expenses, reserves, and debt service from gross operating income. Taxable income differs from cash flow because depreciation and interest affect tax liability. After-tax cash flow shows the amount the investor actually receives after taxes. Investors measure performance using return on investment, cash-on-cash return, return on equity, discounted cash flow analysis, and internal rate of return. These tools help investors determine whether a property meets their income and long-term wealth goals. Review summary. This chapter explained how investment fundamentals apply to real estate and how investors evaluate risks, returns, and opportunities. You explored the nature of real estate investment entities, the tax implications of owning and selling property, and the financial characteristics of both primary residences and income-producing properties. Understanding how to interpret cash flow, taxable income, adjusted basis, gain on sale, and investment performance metrics enables real estate professionals to guide clients with confidence and clarity. These concepts form the framework for evaluating properties, identifying opportunities, and supporting long-term financial planning. Discussion. Why is real estate considered less liquid than other investment types? Answer. Selling real estate takes time due to marketing, negotiation, financing, and closing processes. Because it cannot be converted to cash quickly, it is less liquid than stocks or money market instruments. How does leverage enhance potential returns in real estate investing? Answer. Leverage allows investors to control a large asset with a relatively small amount of their own money. If the property appreciates or generates strong cash flow, the investor's return on their equity increases significantly. Why do income properties often produce higher after-tax returns compared to non-income properties? Answer. Income properties allow depreciation and interest deductions, which reduce taxable income without reducing cash flow. This tax advantage enhances the property's net return. What is one reason an investor might choose a REIT rather than direct ownership? Answer. A REIT provides exposure to commercial real estate without requiring hands-on management, offering liquidity and professional oversight. Closing remarks. Real estate investment offers a dynamic blend of income potential, appreciation, tax advantages, and financial leverage. While no investment is without risk, the broad range of opportunities within real estate enables investors to build wealth through strategic planning and informed decision-making. As a real estate professional, your understanding of investment fundamentals strengthens your ability to guide clients, support investor goals, and uphold national standards of practice. Chapter 18 brings together the essential components of real estate investment analysis and prepares you for more advanced topics as you continue your real estate education.